Hello and welcome. This is Sunny and welcome to the much awaited video of how to invest in 2020. Just kidding. It's not been much awaited, not been much requested, nothing. Why? Because the markets are up. Why? Because the markets are at new highs every single day. Why? Because the going is so good. So last year, 2019 start or 2018 end, I did the yearly investment video. Actually in the last week of December, 31st of December, if I remember right, was because I was getting a lot of requests to do the video about investing for the new year about that. The reason was because the markets dropped 19.8%. People said we haven't been in a bear market. It wasn't 20%, but it was 19.8%. Markets dropped 19.8% in that month of December 2018, and that's why I was getting requests. 2019, markets did great. I got no requests. So, I'm doing this video a little bit later. It's January of 2020 now. And let's look back. We'll spend about 3-4 minutes looking back at the decade of 2019. How was it for investing? Just an estimate. Who knows? 2 minutes maybe. And then we'll talk about 2020, what I'm looking at now, how I'm looking about investing the current portfolio, how about going that, how about investing new money, how do I feel about valuations, about earnings, where the markets are going. Again, it's all about how I feel. I don't know anything for sure. I'm not an economist. I'm not saying that economists know anything. Don't believe them if we tell you that, but probably they wouldn't because they speak in probabilities. But coming back, take a step back. 2019 kind of ended also the decade of 2010s. And just a reminder, 2010 was the first decade without an economic recession in a really long time. I think I heard about 150 years. We don't know. Going back, I haven't really trusted the data that much going that back, but in a really long time, it's been the first time that we've seen a decade without a recession. Now 2014, 2016, 2012, 18, markets kept dropping 10%, 20% every time there was a fear of recession. Every time was a recession is around. Every time was like, this is another bubble ready to burst that was fueled by Fed. But the recession did not come, and we did go through the first full decade in quite a while without a recession. Let's celebrate that, but probably and hopefully your portfolios have already celebrated that till now and by now. Let's look at 2019. So for the 2019, the markets were up about 30%, 31, 29, which index you look at. NASDAQ was up about 35%. Now, funny thing you want to know? Earnings were flat. Earnings were flat and the markets were up 30+%. So if you look at 2018, it's funny because it's not as easy as it seems, it's not as simple as it seems, it's quite complicated. Well, what I'm trying to say is the reasons are quite complicated about why markets go up, go down. It is not as simple as in the really long term, in the really long run. Yes, the earnings, the stock prices follow the earnings, but here's the caveat. 2018, the earnings were up 20%. The markets were flat to down. I think they were up 5%. 2019 earnings were flat. The markets were up 30%. Now, yes, part of it is because markets are forward-looking, results are backward-looking. So yes, that's the reason. Second reason, the biggest reason, sentiment and multiples. Earnings remain the same, multiples change, sentiment, and interest rates. So that brings us to reviewing 2019. The 19 started off with a correction, as I said. That's why we did the episode 2018 December end, because a lot of people wanted to know. And it was undergoing not only a correction, but almost a bear market. That's how 2019 started. Yield curve inverted. Everybody and their brothers and sisters and daughters and mothers and fathers and the whole family were worried about a recession, about picking markets out. Everybody was saying bond markets are telling something that the equities should listen to, that the Fed should listen to. Everybody was saying the bond markets are telling something that the Fed should listen to. And did they listen? Oh boy. Fed come back, cut the interest rates, cut the interest rate again. Globally, all the central banks kept cutting interest rate / making policy easier and easing the balance sheets. Well, what happened? Markets shut up. Now the Fed is behind you. Now the Fed has signaled. So Powell, the chair, actually changed course pretty sharply after last December, 2018 December. And then 2019, he went on so dovish and being so rational and open about things and communicating and saying we don't really need to, the economy and the inflation is not overheating. It does not require rate increases. So we will wait around till there's a good reason to. I agree with that. But at the same time, I agree because there is no to little wage growth. There is no to little inflation. So what are we worried about? There is 2-3% of growth. That's great. But why stifle that? Why stop that? The system is not going in the need shouting for rate increases. So I get that. But what happened? Well, what would you do now? Rates are not going up. Where would you park your money? Oh, the markets. Every sector of the market, every single sector of the market was up. What about energy? Let's look at that. So energy was the worst performing one. Tech was up 48%. And now the January, the red rally is continuing. It's about 52% up in the last year. So I agree. That's what makes US's market great. Why do you want to invest in S&P? Why do you want to invest in US market? Because of tech. That's it. I feel like a lot of countries, not that's it, but you get the point. Like, it's a consumer and many sectors that consumer drives and innovation in many different areas and stuff like that. But tech is the driving power on why the US economy and the markets are so attractive. And last year, they were really attractive. I was saying, and I did buy into a lot into Facebook and further into Amazon and Google. I did not into Apple, and I do regret that. But anyway, tech up 48% as of the year end, 52% now if you look at last year. Communication services 31%. Again, some social media and some tech companies go into consumer services. Consumer discretionary up 27%. Consumer was so good, but then energy lagged. It's very difficult actually to lose market money in the market unless only things that did lose, not only stocks but other asset classes were great. The only asset classes that lost value in 2019 were wine, art, and diamonds. Okay, I guess unless you were in those things, you made money. Even in gold, in such a good market, gold went up. So it was very hard to lose. So if you made a lot of money, if you're up, don't just, pump it up. Don't just, don't be too full of yourself. Because let's all be humble and realize the markets have been so good. People on an individual portfolio that are not as diversified as the market usually do better. I hope you did better, and I hope you did amazing. But also, bull markets they outperform, and bear markets they don't. I did outperform, but it was a bull market. So, if it comes a bear market, I'll underperform because my stocks are not as diversified as the market. They're more risk prone. They're not, the stocks that you would go in a recession and stuff like that. So that was 2019. I think that was more than 4 minutes I said. But anyway, the problem that I have is that the earnings haven't gone up. And for 2020, I know the markets are forward looking, you would say, for 2020, the earnings are set to go up 6 to 10%. And usually, estimates usually go down as time goes. We don't know. Let a quarter come by. It's the first quarter. But what I am trying to say is almost entirely, the rise in the market has been driven by valuations, not by earnings, at least in 2019, by multiples. So the market at the end of 2018 was about 13 times forward earnings. Now, I think it's about 18.5 to 19 times, somewhere in between that. Well, that's almost a 40 to 50% increase. Now, that's a lot. There are two ways to look at it. One way, of course, market is not cheap. It's not at 13 times. It's at 18, 19 times, which is higher than its 5-year, 10-year average of 16, 17 times, So it's not cheap. The second is it's not a bubble. Is it a bubble? I don't think so, because interest rates are zero. And Fed, which is usually an uncertainty, has come out and said 2020 we don't need to raise. We don't need to raise in 2020 unless something dramatically changes. So yes, Fed has given the market a choice to relax and soothe, and don't worry about Fed, don't worry about interest rates. Just go and buy your house. Mortgage rates are not going up. You buy a house, you go Home Depot, you go renovate your house, you get stuffing in. You get stuff in, consumers strong. You get stuff, you buy stuff, you maintain stuff, you sell more, you buy more. Well, you get more debt on your credit card, you pay it back. Well, you can't pay it back, you get a better job. Job market is good, best in 50 years, you get a better paying job. You pay incentives. This stuff keeps going on and on and on. So, consumer is good. Interest rates are low. We've been assured. So maybe 19 times is not that bad. 19 times, maybe that's normal. And I'm not trying to say it's a bubble, but 13 to 19 times, 13 times was value, gold digger value. You gotta get that out of it, get value out of it. I was so badly wanting to invest. 19 times, meh, where is my margin of safety? Where there is no margin of safety. Well, there is, but not too much, because now a lot of things can go wrong. Earnings themselves, we're saying 10% increase in 2020, who knows? Let's see. So any risks that come to the market now, be it coronavirus or anything, China slows down again, or Europe slows down again, or we don't know. Election year is around, not saying that that's a big risk economically, I think, at least now. But whatever happens, there is no cushion in the valuations. At 13 times forward, there's a lot of cushion. At 19 times forward, it's not. And another thing, more than the markets, is I usually tend to give a take on the markets based on what value I am finding in the stocks. So that has been an issue. I have not found a lot of value nowadays. These days, I am struggling to find value, where to invest, because where would you invest? The companies. So of course I'm a growth investor and somewhat value, but mostly growth. So I go after themes that are working, and I feel like that would be working tomorrow and getting better. So if you could go, e-commerce is still working, healthcare is still working, smart home, data, all the fields, cloud is still working. But if you see companies and all of that, so 2019 actually gave you a pretty good entry point into cloud stocks. There was a whole 3-4 months of rut in cloud stocks, and that's where I got into 5 or 6 or 7 positions, established a 1 or 2% position each of my portfolio. So Splunk, Alteryx, Salesforce, ServiceNow. I'm missing 1 or 2 of them at least. ServiceNow, Alteryx, Splunk. I'll tell you more. Workday. So established about 1 to 2% positions in 5 of them, and that was a really good position opportunity. But now that's gone too. Cloud stocks are back up. So I don't find a lot of value. The stocks and the companies that I like and I've been overweight on, Google is now 27 times forward. Is that expensive? Maybe not. The new earnings will come in. 2020 projections will come in. It's 24 times 2021 end. So it has about 10 to 13% of the whole market value in cash on their balance sheet. Account for that, it's now 20 to 22 times. I feel like that's the multiple it should have always gotten, So if it was 18, 17, 16 times before, I did buy it. I said we should buy it, and it went to 20 times, 22 times. So it's normal, it's fair, it's not a bubble, but I don't really feel like putting money in at these valuations. Facebook is still valuable. I think Facebook and Amazon are the ones that you could still put money in. Amazon is going through its cycle of not, working back on putting some pressure on profits, going through the one-day delivery and stuff like that. So it will come back again, but it's a good opportunity. Facebook 24 times as of now, 10% again in cash. So it's about 22 times next year's earnings. That's also pretty good. But on a whole, I don't find a lot of value. Everything I like is at fair price. And what you would have to do with fair prices, either the earnings have to surprise really good, or you would have to wait till the time passes, the new earnings projections come in, and you see those situations working out. So either the fundamentals of those companies improve substantially, which is probably why the prices are going up, probably why the multiples are going up, or we're just paying more for the same thing. I feel it's more like paying more for the same thing, which I don't like, so I'm gonna stay back. Apple 20-21 times forward now. Well, what would you do with Apple 21 forward times? Well, it's probably a recency bias that I feel it's expensive because it was at 12 times about a year back. It doubled. Well, what do we do with that? I don't know. I still believe in the company. I always believed in the company. I don't know why I didn't think it would get re-rated so much. I thought I had time, but it went up to 21 times now. So your margin of safety is not so much now, although as of today, there's not a lot of things that could go wrong with that. Somebody called, so that video got called back. But again, Microsoft is at 27 times. Well, I love the company, I love where it's going, and cloud is where everything is, and enterprise connections, the Microsoft has the highest, so it's difficult to assume Microsoft will not keep growing. Now 27 times is just not a bubble, but it's pretty fair. I don't want to pay higher than that. One I really felt bad was just yesterday I saw some MasterCard, company that I love. Visa and MasterCard have been such great investments that you don't sell off like that. You don't sell off companies like that. But what can I do? It's gone now 35 times forward. So it's like 3% earnings yield. It's like the company is returning at 3%, less than 3% now. The growth rate, though it's very good competitive position, is growing at 10, 15, 17%. It's 35 times, 37 times now, I think I saw last. That's just way too much. Probably earnings, as I said, will just smash expectations and keep going up. And maybe I'm not seeing that, but I don't have enough information to see that. I don't know why earnings would be double or much more than what the estimates are currently there. I have no edge there. So it just seems like way too expensive, these things. And again, maybe value justifies that, earnings justify that, but I have to wait and see. So I feel bad about going out of some stocks because I love them as an investment, but they're just getting too expensive. So I feel like that's giving you my take. I feel it's hard to find value, and so I will stay put. I've raised cash now, about 5% of the portfolio, which is, if you know me, it's kind of higher than I usually go. So I'm in 5% cash now, and waiting around. Sooner or later, I think a 10% correction will come. What reason? We don't know. We never know. Who knows the reasons for corrections, and who knows the timing? They just come when they want to come. They find a reason and piggyback on that. So it may drop 5-10% anytime, and then I think you look at what companies have outperformed their earnings expectations and where the estimates have been rising, the companies who've been doing better among the list of companies you already wanted to buy. And once they fall into your range, everybody has their own range. I have my range of valuations I would like to buy companies at. They're just a little bit outside of that now. As to good values, I still feel, I know, like last year I gave some picks on what companies you should buy or I'm buying. I was so excited. I was like, this is a list of companies I'm buying because the value was so good. This time the value is not that good in the markets, but there's still some companies I would like to buy. Growth companies, I would say Facebook is still at good value at about 210s nowadays. Alibaba is again good value, so it happens, is also in 210s. Coincidence. The third company also in 210s, just kidding, it's not. So Facebook and Alibaba are still good growth companies that I would still buy. And third one is HDFC Bank, which has had some results slow down amidst the slowdown that's going on in India, but a long term, a really great holding and a company. So if I have to leave you with the picks, overall I'm finding difficult to find great companies and great value. They're all fair value. It's not a bubble, but it's still too less a margin of safety for me, and that's why I'm raising cash. I'm not selling the holdings that have done good unless they're going like MasterCard above 35 times or double the big ratio, but other than that I'm keeping them and still maintaining the percentage allocation and raising some cash. But if you want to put in, and if I want to leave you with some names, on the growth side, Facebook and Alibaba, both in 210s, both at about 20 times 2021 earnings for X cash, and HDFC Bank, also about early 20s forward in earnings. These companies are growing at 20 to 25 times percent rate year on year, and I feel like that multiple is very well deserved. It should probably be better. So those three are the growth stocks. Value, Merck and Qualcomm. I bought recently. Qualcomm I'm still playing on. Uber is a good one if you think that is value. Uber and Lyft at 5% of my, getting to about 5% of my portfolio now. I think that's a good turnaround story. So Merck, Qualcomm, Uber, maybe on the value side. And I know I'm putting Uber in value, although it doesn't have earnings. But anyway, it could still have value. That's what I feel. And Facebook, Alibaba, and HDFC Bank are my picks for this year's growth. Let's see at the year end how they turn out to be. Let me know how you're investing, any questions you may have. And sooner or later, a correction will come in, and hopefully then you'll watch this video. See you.